been a while since I've done a video like this, but we're going to look at what I'm adding to my main portfolio. This isn't penny stock related. This isn't necessarily news about the next penny stock. This is just what I'm adding to my portfolio to hold for the long term and with a nice healthy dividend. Welcome back, guys. If you're new to the channel, then please consider subscribing to the channel because you'll get plenty more content, all stock market related, whether it's long-term, short-term, penny stocks, dividend, growth, cyclical, value, whatever it might be. I will try and cover it in this channel, or on this channel, should I say. And while you're down there subscribing, so you don't miss any future content, give it a little like as well, or wait until you've seen the rest of the video, genuinely liked the content, and then give it a like as well. In this video today, I'm going to look at what I'm putting into my main portfolio. So I've been focusing a lot on penny stocks and news about penny stocks for one reason only. It trends, it gets me views, and that's part of what this channel is about. But I also want to let you know what's going on with my portfolio as well. And I'm finally adding a position. I've been looking at a few possible options over the last kind of couple of weeks, and nothing's jumped out at me. I was thinking about dollar cost averaging up or down on some positions I already own, but I fancy something a bit new, so just come across this article in Seeking Alpha. We'll go through it. The company is called Ares Capital, or Ares Capital, I don't know how you would pronounce it, and they are a BDC. It's a business development company with a portfolio of holdings, so it's quite well diverse, and it pays a fantastic dividend of 8.8% as we speak, I believe. So we'll head into the computer, we'll have a look at the article on Seeking Alpha with the compelling arguments about the property. It's still a bit of a growth play because it still hasn't recovered fully from March, April last year, and so we've got a bit of value in it as well. So it's a bit of a value play. It has also outperformed the market since its IPO in 2004, I think I read in there, which is obviously very good as well. So we'll head into the computer, have a look at it, and we'll also buy it live in the portfolio now. It's time to get my money into the market, and so let's go for it. Right, we won't start in the portfolio today because we'll go in that in a second, but we'll start in the article itself. So this was literally released today. We are looking at Ares Capital. It is a blue, or considered a blue chip, as we've got in quotation marks here, blue chip company for the BDC sector, the business development company sector. So I've highlighted the main bits here, but this is on Seeking Alpha. You can go and look at this yourself, but we've got a lot to go through today, and I don't want the video to be too long, so I'm just going to whiz through it and pretty much read an article to you. I know I slate people for doing that on YouTube, but that's exactly what I'm going to do today. For the average retail investor, investing in a broad range of small to medium-sized businesses that make up the core of the American economy is just not possible. Wealthy investors can do it if they opt to do it privately by doing individual companies, or as a venture capitalist or private equity fund. Publicly traded BDCs, business development companies, open this opportunity to the average investor. I've got absolutely no coverage in this in my portfolio at all, so this will be interesting. Good to have a bit of diversity in Ares Capital Corporation as well. So got a little note here just saying the company is in a very sweet spot for fast growth and continues to generate high income. We've got some growth hopefully coming. I'll show you the graph in a minute, how it's not quite recovered from the dip in March, April time yet. So a little history: since November 2004, ARCC has generated some very attractive total returns of 11% per year with dividends reinvested. So that is just about beating the market, which is good. This has been a stock that has rewarded some investors for a very long time. Ares has strongly outperformed the S&P 500 index over the period since 2004. The stock has returned 579% since inception in 2004, while the S&P 500 index returned 373 during that time. Illustration there. So again, head to Seeking Alpha and have a look at this yourself if you want to read the whole article, but it's outperformed, and heavily outperformed since the dip as well. If you have a look at the dip right here, huge dip in I mean, I don't know what kind of value that must have lost, but we've bounced back seriously strongly, and it's outperformed the S&P 500 in its recovery as well. So look at their business model. ARCC has a portfolio that's largely composed of secured loans. 45% of the portfolio holdings are first lien secured senior loans, which are the head of the line to collect. As secured loans, they have the added safety of being backed by collateral in case of default. So the vast majority of the portfolio is secured loans. I think at least 73%, it goes on, at least 73% of the portfolio is composed of senior secured loans. Defaults of secured loans tend to be low and recovery tends to be fairly high. The The holdings are also not very concentrated, as the largest holding in a single company is 3%. So they diversify pretty thinly as well. So they're not holding 10% of their portfolio in one particular industry sector or company. So again, we've got another illustration here. 80% senior secured loans, average position size is 0.3%, and the largest is 3%. So they've spread themselves pretty thin, so they've diversified their portfolio as well, which is great to see. The chart below shows how diverse the holdings of Ares Capital are. Diversification helps reduce risk because the problems in one industry have a lower impact on the portfolio as a whole. We know that, that's obvious, so I don't need to explain that to you. Of particular note are the 4 sectors shown on the right hand side. These are problem areas in the market as a whole, but ARCC has kept its exposure small. So we've got hotel and gaming, yeah, obvious. Oil and gas at the moment, obvious, been hard hit. In fact, I think it says it here. Oil and gas have been a challenge for several years now, but have been especially hit. Hotel and gaming have been hit hard by travel and other restrictions imposed to address the problems that we're going through. Retail and distribution, so retail obviously has been hit. I mean, most shops certainly in the UK at the moment are closed, non-essential certainly. So it goes on. ARCC have comparatively low exposure to these sectors. That should produce better cash flow and fewer defaults and downgrades, which is great. Obviously good for their business model and fantastic for their business model, exactly what they want. Loss rates from defaults also important for any BDC. Anyone can make money lending if all borrowers always pay back loans in full. That isn't the case, and profitability is dependent on making loans where defaults are low and recovery rates are high. Recovery rates being recovering the money from the loan. Ares Capital does a great job relative to other comparable companies. So if you have a look here, Ares Capital here and here, we've got subordinated unsecured loans here. Default rate is 2.7%. or loss rate, and we are less than 0.2%. And we've got broadly syndicated market senior loans and middle market senior loans. First lien we've got 0.6 and 0.9, and they're less than 0.1. So Ares Capital are doing very well in terms of their loss rates, which is again great for their business model, so really nice to see. It goes on, what's great there, historically the ARCC portfolio companies have done well. We must now look at how well their portfolio companies will hold up given the various challenges to operations from dealing with everything that's going on at the moment. Over the last 3 quarters, the portfolio companies have increased their earnings, and Q3 earnings are above the level earned in 2019, which is very remarkable. It is very remarkable indeed. Also, the interest coverage ratio of its investments have improved over the last 3 quarters and is even higher than last year. A solid improvement shows that ARCC is invested in solid companies. Not wrong. Can't argue with that. Let me head down to this section here. ARCC consistently out earns its dividends. This is quite important, certainly as a dividend investor. From the end of 2008, ARCC has continued to pay substantial dividend with occasional special dividends, which is nice. So historically, ARCC has generated a steady stream of dividends. This makes it an excellent choice for those looking for a steady current income. So again, you can go on Seeking Alpha and check the company out, and it's got all the information which they've planted on the graph here. Unlike some other BDC companies, the dividend always has been covered by its earnings. So ARCC has consistently out-earned its dividends. What it means by out-earned its dividend is the money for the dividend, for the distributions to shareholders, is coming from what it earns, or what it's earning in revenue and from its profits, not from having to leverage and borrow money just to pay a dividend. If you have a look at the net asset value trend, while ARCC has been a consistent dividend generator, an investor needs to look at the NAV and net asset value trend while evaluating any BDC. This is because NAV trends can tell you how well supported the dividend is, or if the company is paying out more than it's actually generating in cash. A NAV decline, particularly one that lasts a long time, can indicate that the company is paying out too large dividend, or if it's issuing more shares that are diluting current investors. As you can see in the chart below, the long-term NAV per share, or book value per share, trend for ARCC is increasing. The impact of whatever everything's going on, or NAV is evident. We can see that obviously from the dip there, but even with this drop, the NAV trend over the last 10 years has seen big appreciation. We like that. This should provide a good opportunity to see NAV return back to prior levels as the economy recovers. So we think it's probably a little bit of a value play as well. There's loads more you can read here, but I'm just going to point this bit out here. Attractive valuation. If you decide to buy our ARCC, you'll be buying into the largest BDC with a proven track record and reliable dividend distributions. This is almost like saying, right, I want to buy into the tech sector. I want something that a company that handles technology, computers, phones, all this, that, and the other. Who are you going to go for? Are you going to go for the lesser known, not doing that well, whatever it might be, Nokia, BlackBerry, maybe, if you think they're going to be short squeezed, but you'd go for Apple, right? So if you decide to buy Ares Capital, you're buying into the largest BDC company with a proven track record and reliable dividend distributions. They're a pretty safe play. ARCC is currently trading just a 10% premium to its net asset value. So that shocked me to begin with. I looked at that and thought, well, I'm paying 10% premium on its net asset value, and you'd use a NAV valuation when valuing things like this, companies that hold other companies, because you're looking at the holdings that they have, or ETFs or CEFs. And a 10% premium on its NAV, really you want to find a company that's actually trading at X amount percentage under its NAV, really. But it goes on, we consider that the current valuation is attractive and would not be surprised to see the premium to NAV continue to increase. Investors tend to reward reliable dividend payers with higher prices, such is the case in Mainstream Capital. So I'm reading just this section here now. Mainstream Capital, which trades a hefty 50% plus premium to its NAV. So I didn't know that. So ARCC offers an 8.8% yield, higher than the yield of Main, which is Main Street Capital, at 7.4, and trades at a much better valuation. So the upshot is, bottom line, ARCC is a top-notch BDC with a 15 years track record and outperformance. It still trades well below the valuation of peers with similar performance. Income investors can still buy it at cheap valuations compared to other quality BDCs trading at exorbitant valuations of over 50% above NAV. So that's the upshot. So again, head to this article and have a little look for yourself if you so wish. We are going to go into the portfolio now. ARCC, I said it enough times doing that to know. So if you have a look at this here, ARCC, huge green day, up 3.8% at the moment. Is that going to spook me? We'll probably see a small dip here, maybe. Or, of course, don't forget, it may continue going up. And then when you buy in, do you just wait for a dip and then it never dips? Who knows? Which is why, no matter whether it's up or down, in true dollar cost averaging fashion, I don't know how many I want here, so let's just put a number in and see what it comes out with. Look at that. Total cost £815, and I currently have 817 available. So let's just go for it. There we are. It is complete. Thanks for watching that, guys. I'm sure that was incredibly boring for a lot of you. May have been a bit interesting for others. Let me know in the comments down below what you're getting into, whether you think that's a good play, whether you think that's a good buy, or if that's not a good buy, what you would be buying instead. Let me know. Would love to hear your thoughts and we can have a little conversation about it. Don't forget to like and subscribe to the channel. It really helps the channel, and I'm trying to grow this as fast as I can, but still provide you guys with as much value as possible. I hope you enjoyed that video. I hope it wasn't too long-winded and boring, and I'll catch you guys in the next one. See you later.